Hi, everybody. Mike Hill and
Casey Harding.
Casey Harding with Money Matters with Hill Financial Group. We, of course, are in front of the green curtain, green for money. That's kind of our trademark. We're trying to, Joe Rogan's the red curtain, so we figured we'd go green. Podcast, and thank you so much for all of those that are subscribing. Please share on Facebook. We're getting a lot of good feedback. We're getting people asking us to do different podcasts, which I didn't know anybody was watching, so that makes it even better. But we are getting a lot of great feedback, and we hope that you go back and see some of our short ones or long ones, whatever. But please like and follow and share with friends, especially here in the community, because I think we're getting some information out there in little 10 and 15-minute clips that isn't readily available to the general public. Unless you Google it and then you read through 15 things, half of them were paid for to be advertisements on there, so you don't really get a lot of information.
For sure.
So today we're talking about inherited IRAs. It's part two.
Yep.
It is a part two because can be a complicated subject. We talked about the Secure Act last week. Mm-hmm. This week I want to talk about the tax implications of IRAs when you inherit them and kind of what happens to you when you inherit it. And I want Casey to take this one over because, like we said last week, there's $65 to $70 trillion transferring from parents to children and grandchildren. Mm-hmm. It's estimated over the next 10 years.
Yep.
So maybe you have an uncle you didn't know about, or maybe you have an aunt that you didn't know about that you inherit some money from. So even if you're like, my parents don't have anything, this isn't important. You never know. If nothing else, build your wealth so you know these rules when your kids inherit it from you.
That's all right.
So go ahead, Casey. Tax implications.
Yeah. So I mean, if you're a non-spouse beneficiary of a traditional IRA, there are those distribution rules, like we talked about in the previous podcast. That you have 10 years that you have to exhaust those accounts, and if you are still working, that could incur some additional tax consequences there, and or not tax consequences, but tax liability. You're going to pay higher taxes because you're having to take out that additional income. And so there are some strategies that we can implement, whether it be taking that, purchasing a life insurance premium or life insurance policy that you can use those distributions to put that money toward, that will then allow your beneficiaries to inherit that money tax-free, which is one great strategy. Another option would be to take those distributions out. Yes, pay your taxes on them, but then you could use the additional funds to go ahead and convert some existing IRAs that you have over to a Roth, which gets you more tax-free income for you later, which that's also a great strategy that you can do for those distributions that you have those requirements there. You also, if you don't want to do it over a series of years, Mike talked about this. If you're close to retirement, you could potentially, depending on how well you've done towards saving for your retirement, you could maybe retire early and use those distributions. Stop the income that you're working for. Use the money that you've now inherited to be your income for those few years to bridge the gap until you get to Social Security age, whether it be 67 or delaying that till 70 and maximizing that Social Security benefit. But the biggest thing is we want to understand where are you at in your in your career, and where are you at on your wealth building phase of your career, and what are the now that this is in place, what are the strategies that we can implement to help mitigate those taxes?
What's one? I mean, and I know I've had to deal with this with some clients that have taken out that have done a conversion, a Roth IRA conversion. Which, by the way, if you're retired and you have an IRA and you're in your late 50s, early 60s, if you are not doing any kind of Roth conversion analysis, call us.
Yeah.
I've done 20 backdoor Roth IRAs. If you don't know what that is, we've got publications on it. We can go over it with you. But absolutely, you need to be looking to convert to Roth IRAs But it's not just, hey, let's just throw a number at it. Let's see how much it keeps you from going to a higher tax bracket. But I want you to talk about some other, because one of them I know we wrote down. I had to deal with that 2 times, and people, forgive me, a lot of financial planners, a lot of CPAs don't know to look for this, because those clients asked me, hey, my CPA doesn't know what this means when I do a Roth conversion. Right. How does it affect my Medicare?
Yes.
Could you kind of say what I mean by that?
Yeah. So by doing those Roth conversions, there's potential that you, depending on where you're at in the like income bracket, that you could pay higher Medicare premiums.
And not just Roth conversion. I'm just talking like we've been talking about. You inherit an IRA. I want to take $100,000 out and go buy a Corvette.
Yeah. So there are other things within the tax law and tax brackets that could be really impactful to your tax situation if we're not mindful of how much we're converting, or how much income you have coming in from your various assets, whether it be working or other Social Security, your other IRA distributions that you could be taking, but your tax on we're really trying to mitigate you having to pay higher premiums on your Medicare, mitigating taxes that you could owe on Social Security, and then net investment income tax. So these are the 3 things that we need to be aware of and mindful of how much income you are getting, especially on those Roth conversions. But this is where a CPA will be, like we talked about in our previous episodes, of having that relationship with your CPA and knowing that, making sure that they're aware of it, that we can plan for and plan around to help with that process. But Mike, why don't you talk about a little bit of coordinating with a CPA and some of the other things that are available to them in regards to that.
And to that point, and we, whenever we do plans for clients, we look at the tax consequence too. I don't think, and I'm sorry, I'm probably going to get a lot of bad emails. I don't think enough financial advisors do that. They don't coordinate. What are your tax implications? Hey, I made you 10%. Okay, but if half of it had to go to taxes, no, you only netted 5%. Is it short-term capital gains? Is it long-term capital gains? Did it put you in a higher tax bracket? Did it make your Medicare premiums go up? I can't stress this enough. Too many people look at the top number. Yeah. I made 10, 12, 13%. That's great. It's not what you make. It's how what much you keep.
Yep.
That is the bottom line. What I put in my pocket is what I can spend, not what I get to brag that's on my statement. That's great. But if what's on your statement is really only half of that after taxes, then you're not doing correct planning. So again, I didn't mean to get into all that.
No.
To that end, how many of you out there, we have relationships with a couple of really, really good CPAs. Here, right to Adam. He's one of them. And he is one of the good ones, because I could call him up and say, hey, this is what we're thinking about doing. Would that put him in a higher tax bracket? What does it do with IRMA, Medicare premiums? What do you think that's going to do there? Well, Mike, maybe you should only do $80,000 instead of $85,000, because by my calculations with the ones that you gave me, we're right around that range.
Yeah.
That, I can't stress that enough. If your CPA and financial advisor don't know each other, get a phone call going. We need to know who your CPA is. First of all,
because you're going to be mad at us or mad at them because they weren't aware of what was going on, and then you're paying more in taxes than you really need to.
Well, and I'm doing with this personally right now. I finished my taxes. I do it. I always do an extension every year. I mean, I'm like the plumber that helps everybody with their pipes, and then I come home and my pipes are terrible. So I'm getting my taxes done. But raise your hand if you've had to call your financial planner or bank or whatever to get a 1099.
Oh, yeah.
Okay, all the time. If I know your CPA and you say it's okay, if you call me up, or he can now call me, hey, Mike, I need a 1099, why should you be in the middle of it? You don't need to be the middleman. I can't tell you how many times Adam's called me, hey, Mike, do you have a 1099 from last year? We're going to call the client, make sure it's okay, but if that's okay with them, just send it directly to me. Instead of sending it to you, you sending it to them. So I can't stress that enough. Timing withdrawals to maximize tax implications. But here's a good one. And we live in a very blessed community. We have a lot of clients that not only tithe but give to charities. I mean, right here at Union, we've done, how many charitable events.
Yeah.
I mean, so in the whole the Alzheimer event, I mean, we had 1,500 people at that. This is a very, very get behind you town, which I love still. But there are things called like a qualified charitable distribution. Fidelity has one. I think Vanguard. There's companies out there that do this, where you could put money into an account. Then when you pass away, it is distributed for you to a certain charity or church or whatever. You don't have to do it. It's set up before you die, of course. I love those for IRAs.
Absolutely.
Love them because it's done. It's distribution. It's a taxable consequence. Leave as much tax-free money to the kids, but maybe let the taxable money to the charity because they don't pay taxes on it. So that's just. But a qualified charitable distribution is, if you haven't never done one, or if this is something you want to do and you pass away, ask your financial advisor or CPA about how it works. I can't stress it enough. It is a very good way to leave a legacy without having, no offense, paying an attorney gobs of amount of money to implement your plan for you.
Yeah.
So here's the thing that we're going to talk about a lot. I've had people pass, just this year, my grandmother passed away, very, very close with her, and it was very hard. But talk to me, Casey, about the emotional side of inheritance. That's the thing that I don't think enough people talk about.
Yeah. Well, I mean, the biggest thing that I think, to be aware of is just, if you've got a good relationship with your parents, probably your biggest concern is, I didn't know I was going to inherit this, or I did, but we never really talked about like what they wanted me to do with it, and so just trying to figure out how to honor their legacy. And so maybe it's figuring out, well, what were the things that were important to them, whether it be a charitable organization or their church or whatever it might be, that you want to use those resources towards advancing, those nonprofits, things like that. So, I mean, just trying, or maybe it's that your parents were super concerned about making sure your kids, went to a good college and didn't have to go into debt, and so you use those funds to fund their college. Those are some of the, I mean, just kind of off the top of my head, but it's really just kind of understanding ahead of time, like what was important to your parents, and if you're wanting to honor them by what they've get entrusted to you or given to you, we can figure out a best strategy for that. That goes along with understanding your family's values and financial goals, and maybe yours are different than your parents, and so there are ways that we just kind of talk through what is at the heart for you around your finances, and what's most important to you, and then we can kind of come up with a plan to kind of help you leave that legacy that you wanted or that you felt like your parents had for you.
Again, if you're not sitting in on the meetings with your parents, please call them, and don't be like, Dad, I want to know how much I'm getting. Dad, we don't even have to talk numbers. Can we just talk about what accounts you want to do what, how much you want to leave each person, who's the executor, okay, all the things. I mean, I've had clients where and I love this, where one daughter is the medical directive, and then one daughter or one son is the financial directive. So that way, one gets. It's unfortunate, but you've got to do these things as you get older, and even at our age. I mean, my parents are in their late 70s. These are the things that I'm dealing with. Yeah. So we had a note on here. Could you kind of
the sudden wealth syndrome?
Yeah, describe what we mean by that. So, what is the sudden wealth syndrome?
It's I had no idea my parents were this wealthy, and now we've inherited 6-figure, 7-figure accounts, and we have no idea what to do. We like that. This is just unforeseen, and there are some pitfalls of like, well, I'm gonna go out and get a new house. I'm gonna go out and buy the Ferrari, that I always wanted. All of those things, or it's just like now we don't know what to do, and so we're crippled with what to do, and we do nothing, and then we basically are going to start paying Uncle Sam 60% of what we've inherited versus being able to utilize it in the best way, so that we can keep as much as we can for ourselves or for the organizations that are important to us. And so it's just that kind of shock of like, what do we do, and And so it's that crippling like sudden wealth syndrome.
I think you hit the nail on the head. I think we both have read it. One of my favorite books is The Psychology of Money.
Yeah.
Read it a couple of times. Great book. But one of the first chapters talks about a janitor who put himself through college. He worked at a gas station, didn't make a lot of money, worked 2 jobs, bought his first house at like 38, 40. I can't remember the exact age. Saved, put it all in blue chips. Died at 92. Had $8 million. Left $2 to $3 million to the hospital, the rest to his kids. Everybody's like, what? He was one of the few people that died with more than $5 million. It's very rare.
Yeah.
I say that. The kids, in his will, he put in there they'd only get a certain amount every year. He was even still saying, I want y'all to learn how to save when you die. Then you had a Merrill Lynch rep. Big on Wall Street. Had an 18 to 20,000 square foot house, all the bathrooms, all the cars, all the things. Financial crisis hit, was dead broke. Left nothing to his kids when he died.
Yeah.
So to your point, yes, in death, but sudden wealth syndrome could even be while you're living. Be responsible. It's okay to have fun, but if you inherit this money and you just go out and blow it, you're leaving no legacy, and you're basically dishonoring the work that your parents put in for all those years. That's my opinion.
And Mike, I think we've talked through a lot of. I mean, we're going a little long on this one, but I think we've talked through all of the mistakes that to try to avoid as we've talked through some of this. And so the final thing I have for us is, what questions would you ask your advisor if this situation came up for you?
Oh my gosh. Well, first of all, okay, let's act like I'm not a financial advisor, because I deal with this all the time. And unfortunate. And then I will say about 70 to 80% of the time, it's women that come in. It's widows.
Sure.
That come in. And honestly, half the time it's like, I have no idea.
Yeah.
I don't know what to do. The first thing we have to tell them is, we are not making plans today. Today, grieve, show me the accounts.
Yeah.
Let's look at what you have. When you're ready, we'll start a plan. Right now, we just got to make sure you have enough money to pay your bills and that you have a checking account. And so I would definitely make sure that you have joint accounts on everything that's non-IRA.
Non-IRA, yep.
Make sure your beneficiary designation is correct. And what I mean by that, and I get this all the time, well, my wife's my beneficiary. God forbid. What if you're in a car accident together? What if, and I've had this happen, just had this happen with the client, one of my favorite couples, sweetest couples, 50 years married. He passed away from lung cancer, smoker for all those years. He passed away from lung cancer. She passed away 8 months later, not from disease, or just basically stopped eating. Died of a broken heart. I'm not kidding.
Man.
So during that 8 months, you think I could have went to her and said, hey, do you mind, Miss Smith, if you would put on your kids as your beneficiary just in case anything happens to you? No. So I would definitely, when you inherit the money, or even your parents right now, make sure they have beneficiaries and contingent beneficiaries. And then on non-IRA accounts, have payable on death when you're at a bank, transfer on death. Why we can't agree on the terminology between banks.
Right.
But have payable of death, if it's not a joint account, payable upon death or transfer on death put on your account. So that means when you die, it doesn't go through probate, automatically goes to whoever's listed as the owner. I mean, so those are the things. Ask your advisor, how should my accounts be set up now while I'm living beneficiary-wise? How will this impact your taxes and your retirement plans? Well, if you've inherited money, again, we talked about the taxes. Are there ways to offset this taxable income? Absolutely. And I even have other clients. Mike, I have older clients now. I'm worth $1 million. Love my kids. We plan on traveling. I don't know if we want to leave them anything.
Yeah.
The wife normally is the one going, now, Carl,
Sure.
let's leave them something. Have a long-term care policy maybe where you have life insurance attached. What I mean by that is if you don't use a long-term care, which now the cost of long-term care is skyrocketing.
It's insane.
It's one of my scariest things right now. But you have long-term. If you die, the life insurance. So life insurance is tax-free. So let's say you spend all your money while you're leaving. At least a life insurance policy would pay the kids. You'd leave some kind of legacy. And again, I don't like to push life insurance. It's not what I'm doing at all. It's just it's a way of leaving a legacy that is tax-free
Correct.
to your kids.
Yeah.
And the younger you do it, the cheaper it is. Are there any state-specific rules to be aware of? Yeah, absolutely. In Texas, we don't have a state income tax.
Yeah.
You live in another state, it's the state you live in, not where your parents live.
Yeah.
Okay, so if you live in Alabama or you live in a state, or Iowa, you live in a state that has state income tax,
Yeah.
you're going to get hit with state income taxes on that inheritance too. So those are the things that I would make sure that you would be aware of. Should I take a lump sum? That kind of depends on your own tax situation. I pretty much always advise against that because I'd much rather you have tax-deferred growth or if a Roth tax-free growth.
For sure.
But can you share just one story, Casey, of a case where maybe you had a client that inherited money or, or something a question that was brought up to you or a concern?
Sure.
I love giving real life stories.
No, absolutely. So, I mean, I've had a client who, her husband passed away during COVID, and basically just stay-at-home mom, and didn't really know, kind of what to do moving forward. And so we just worked with her of kind of like you said, let's take our time, figure out what we need to do, and create a plan, and kind of put that, what was there available to her in a distribution plan that's going to help her and the kids, and also maintain kind of their lifestyle to the best that they can, and just really walk with her, and kind of helping her understand the financial impact of what's going on, and really just comfort her in how we've invested those funds will long term be able to maintain itself, and give her some peace of mind.
I think what I hear from that is, and that's a good story, especially, I mean, we did have a couple, we unfortunately had people that died from COVID as well. It had to deal with a lot of beneficiaries and people taking over, but this is, maybe I'm thinking about this because I just got back from vacation. I know I don't have a lot of sunscreen. But it's that would be my biggest advice. You meet with somebody you trust.
Yeah.
Make sure they've got a couple degrees or they're educated and know what they're talking about. But first of all, meet with somebody you trust. And I get that a lot. Well, I go to church with them. Well, he's friend, he's my cousins.
Mm-hmm.
You have to trust them inexplicitly. To basically just give you the advice as if they were meeting with their own mother or own sister or own brother. I mean, I can't stress that enough. CPAs as well. And how do you get that? You just know. Women especially. You have intuition. I got 5 daughters now, basically. I have 3 sisters, so 6 nieces. I've been surrounded by women my whole life. So women's intuition is no joke, as we all know. We're all married. So, but I will tell you that more people spend time planning for vacations every year than they do their financial plans.
Right.
So if you inherit money or if you haven't inherited yet, take the hour or even less to have some kind of plan in place for when this does happen. This is the one thing we know that's going to happen. Right. The one thing for sure that we know is going to happen. For sure. Okay? There's only one person that I'm aware of that's been risen from the dead.
Yeah.
So I 1,000% have to make sure we have a contingency plan in place, to make sure we have a plan in place when you pass away. I love the story that you gave. So that's part 2 of inherited IRAs. I'm
probably
Mike
could have
Hill.
done part 3 and 4 there.
We could go on forever. But if you have questions, definitely reach out to us. Reach out to your own financial advisor. I hope this was helpful. Join us next week. We're going to be talking about credit and credit card debt and how to increase credit scores. So,
perfect.
But I'm Mike Hill.
And Casey Harding.
This is Money Matters with Hill Financial Group. Thank you.